Welcome to Markets Now. I'm Michelle Rook with Alan Brugler of A&N Economics, and a mostly lower day in the livestock futures. We were mostly higher in the grains, except for a few wheat contracts. And Alan, let's start off talking about corn and soybeans and the WASDE. Obviously, we saw lower yield and ending stocks. Were they lower than what you anticipated?
That's definitely the case on the soybeans. I was looking for something that, 52, 52.2. There was some pretty good data out there that said that the August and September dryness resulted in some lighter test weights and some two bean pods and some aborted pods, that type of thing. Plus, you had a little bit of hurricane damage in the southeast. So, a lower yield, national average yield was not a surprise. They went a little further than we thought or the trade thought with that 51.7, and therefore you got a bigger production cut and a tighter ending stocks number. Corn may still be slightly high. Our virtual corn tour in August has a pretty good track record. It suggests we ought to have 182 and change for a final number. USDA came down to 183.1. So again, kind of a drier late finish to the harvest. That tends to pull the bushel yield down, but we also have to remember it tends to reduce the abandonment. You don't have weather problems resulting in ears falling off the stalks as much, or down corn, muddy conditions, those types of things.
Yeah. So we did see ending stocks lowered 80 million bushels on soybeans, 60 million bushels on corn, kind of a muted response to that. Is it just because that's not enough to really move the meter in terms of price or not?
Yeah, we're still setting on fairly comfortable stocks. To get beans really excited, you got to get down to about 350 on ending stocks. For corn, 1.4, 1.5 would get us to $5, I think, but we don't have that yet. So you need to see some more progress on the consumption side. You want to see that these prices that we're currently at are not rationing demand, that they, in fact, we're using more corn for ethanol, we're using more, creating more exports, maybe more livestock feeding would be helpful on the corn side. You want to see that the 430 or 440 March futures is not a limiting factor in corn. USDA didn't change the cash average price on corn. They left it at 410. That's enough below last year that you should see those consumption responses. The smoking gun or the 800-pound gorilla in the room is what happens after the new administration comes in January.
Right. And of course, we had an interesting reaction after the election. And for the week, we're ending with corn up about 16.5 cents, and beans up about 36 cents, which is a bit of a surprise considering all the concern about Trump and tariffs and what's going to happen when he takes office. What do you anticipate is going to happen with demand going into his presidency and maybe after?
Well, I think there's a couple factors we have to look at here. Number one is campaign rhetoric. Not everything that's said by either candidate was probably ever going to make it into policy or into actual implementation. Congress's job is to trim and adjust and make things fit on the things that it can control, and notably budget. And some things will work out just because of you can't implement them the way that they were originally said. Where am I going with that? The tariff talk, tariffs are a bargaining chip to a degree. Some of that may be modified if there are concessions made by other parties. The main thing you have to remember is that the industry made a lot of changes after the 2018-2019 trade war. There was a lot of production moved out of China into Vietnam and Cambodia and places like that. Supply chains were being diversified. China's become more dependent on South American supplies and less dependent on the U.S. Therefore, probably more likely to draw a hard line on imports from the U.S. after February or March, maybe even January.
So Do we get front loading from countries like Mexico and China going into January 20th? Have we already been seeing it?
We've already been seeing Mexico being very aggressive on imports. Of course, there are some potential frictions with Mexico as well. There were some threats made about pulling out of the USMCA agreement, even though that was implemented during the previous Trump administration. There's certainly some friction there, but I think I think Mexico was trying to get ahead of the Chinese and other major buyers. The Chinese have been very aggressive buyers over the last couple of months, trying to bring in a lot before any potential closing of the door, if you will. So, uh, you know, we have to remember though, for soybeans, the U.S. typically is going to send 75 to 80% of the year's exports go out in the first 6 months. That's normal. All right. In a really good year, you're up in the 80s. And then South America gets the last half of the marketing year. So, this is what should happen, what normally happens. We should have front end loading, and we'll see how it plays out in the end. It'll end up being a case of are they forced to buy from us? More likely, what'll happen is you'll just have displacement. You'll see a larger exports from Argentina or Brazil into China, and assuming there is a trade war issue there. And then you'll see the countries that normally buy from Brazil and Argentina buying more from the U.S., but it'll be a little later in the marketing year.
Yeah. So one thing that's been holding up the soybean market has been this big rally in soybean oil. We were up 247 points for the week. I know we're chasing palm oil, which has been hitting new contract highs. How long can bean oil keep going and holding up soybeans, in your opinion?
Well, bean oil is still very dependent on industrial use, i.e., renewable diesel. We're not at the limit here because we actually had backed off a little on bean oil usage uh, in favor of palm oil, in favor of some of the livestock greases as well. Now, higher palm oil prices makes bean oil a little more attractive for that renewable use, but I think we do have to keep an eye on the crush plants that are coming online, and also on the renewable diesel processing capacity, which has some of those expansions have stopped or haven't even had shovels in the ground yet. Some of the big ones have kicked in, the Phillips one in California, for example. But bean oil's very, very dependent on the industrial use. It's not going to be food use that drives it. And trade policy does tend to affect the palm oil.
And used cooking oil from China, will that pretty much stop? I mean, will they either put tariffs on it, or will Trump ban that altogether, or what do you think?
Well, that's a tricky one. Obviously, if you're pushing renewable energy big time and you want U.S. to benefit, then you would want to restrict the used cooking oil, particularly since some of it's not really used. We think it's actually virgin palm oil. It's just been slid in because it's cheaper than bean oil.
Right.
So, but the underlying question there is, okay, if the new administration wants to back off on the EV push a little bit, that's basically going to allow for more diesel use and more gasoline use. Well, if you're doing that, do you want to restrict the production by high prices, or do you want to let it go? So there's a lot of layers to this thing.
No doubt. All right, let's also talk about the wheat market. We didn't get much of any changes on the balance sheets in the WASDE for wheat. But what is that market trading right now? Because we have seen some improvement, at least in weather, in some of the HRW areas.
Yeah, the weather is improved. Crop condition ratings for winter wheat weren't very good. We were a little too dry for too long there. This is helping. USDA, as you mentioned, didn't do anything. They did raise hard red spring imports 5 million bushels, and they raised food use just a little bit in this WASDE. But We're trading a little bit of U.S. weather, but mostly we're trading Russia. Okay, we're trading Russian export prices. Russia had very strong exports in September and October. Looks like they're trying to raise the average price for those exports by some informal and formal restrictions on exports. The most recent Egyptian tender went mostly to Ukraine because the Russian stuff wasn't available. So, to the degree that Russia says, hey, we've got to slow down exports because we're pushing up domestic prices, that helps the US and Europe to make some more sales. We do have to watch out for Australian supplies starting to become available as we get into year end, though.
And the cotton market was down slightly. The ending stocks number from USDA in the report today up about 200,000 bales, but that market has been leaking lower before today.
Yeah, that's a great word for it, leaking lower, grinding lower. The problem is you've still got over 4 million bale carry-out estimate. That's been done a couple of times here in the last 5-6 years, but it's looser than what last year was, and so the market's trying to find some consumption. You saw the export estimate lowered slightly in this report, and you've got technically you just got a declining regression channel from starting out at about 76 cents and then drifting lower since then. So the market's trying to buy some more demand, and it's got the same issues that beans do for 2025 because China's one of the big cotton importers.
And the cattle market ended lower. We did have some lower cash trade today, and cutouts were down about $6 coming into this session. And so how much more downside do you think we're going to see here? We did manage, I think, to hold this week's lows, but that's about it.
Yeah, I think the cash price was down because the cutouts were down. Okay, and this is kind of a tricky period for the box beef because you're coming into your Thanksgiving demand here. There's that shift to turkey and ham, so it gets a little harder to sell. And we had been pushing well over $300 on that box, so that's been a price level that's been problematic all year. So I think you get a little bit of a pullback in the cutout, and the packers are working on fairly thin margins yet, at least if you're just looking at cash cattle versus the cutout, and so you're going to get that pass through. The board just kind of recognized that today. We did a little technical damage. We broke the 1/3 speed line to the downside, but I'll wait till next week to reserve judgment on whether or not that was fatal or not.
Yeah, it wasn't the best close, that's for sure. Big question about, stock markets hitting new highs, and we've had money flow going on this week, as you mentioned earlier. What do you see a little bit longer term here for the next couple of months as far as, does the stock market keep hitting new highs, and what do the funds want to do here? Where do they want to put their money?
Well, as long as you're running the S&Ps and the Russells and the Dows into new highs, they want to ride the horse that's winning the race. So that the hot money that can jump between assets is going to stick with I think the stock market for the time being. But you're going to get overbought. You're going to get a pullback. I've talked to a couple of stockbrokers this week, and they're all like, "Yeah, this is good, but we're actually cashing out some of our bigger gainers and looking for other places to invest." Now, at this point, they're just looking for other stocks to rotate into. But if the overall market gets you some oscillator sell signals or breaks some key trend lines and moving averages, then they might see a little more rotation back into commodities. Crude oil's tied up in that. Interest rates are the one that I'm really watching right now because while the Fed cut their rate 0.25% this week, the market, the 10-year notes, as an example, had increased yield all the way since the last rate cut. So the Fed cut rates, but the futures were going higher on the 10 years, basically steepening the yield curve, and that affects the money flow as well.
Yeah, I think they've gotten over 4.5%. So it's been interesting to watch that longer term rate go up with the shorter term going down. But all right, always appreciate you. Thanks so much, Ellen Brugler with ANN Economics, and that's Markets Now.